Stocks continue to run, especially small cap stocks and financials and industrials and all those areas in the market that have been lagging behind. They've been on a winning streak for the past week, and that winning streak continued today to the point where some breakouts have occurred. We talked about some breakouts last week on Friday. Not only have those breakouts solidified, but we've got other breakouts. And the Russell finally, to a degree, caught up to where the other large cap indexes are during this past week, 10 days or so. So what's the significance of that? I'm going to break that down in today's video. We're going to take a look at a stock that was in a really strong sector that had been leading that is now weakening, and talk about how to play its short-term weakness as well as its bullish long-term trend at the same time. So let's go ahead and get started. Today is Wednesday, May the 27th, 2020. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate posture remains strongly bullish. Market sentiment now is nearly across above 50. It's at 48. We are easily now above, like entrenched up above the 62% Fibonacci retracement. And you wonder, like, why has it been holding on, especially when the Nasdaq is not only above, got above the 62% retracement over here a few weeks ago at the end of April, and the S&P has been kind of flirting with the 50 all the way, or excuse me, the S&P was flirting with the 62% this whole time from April, but never able to really get above until this past week. Partly because the Dow, you can see the Dow's been languishing, and it's barely getting above the 62%. Now remember, this is a price-weighted average. It's not a market cap-weighted average like the S&P, so it's a little different. But here's the bigger story. The Russell 2000 has finally eclipsed the 62%. You can see up until this week, it was flirting. It couldn't get above the 50% level. In fact, back over here, it was barely able to get above the 38% back at the end of April 24th, April 21st to 24th. This little stretch here where it really had some outperformance. I tweeted about this earlier today. You can follow me at DavidSettle42 for more content in between the videos. But back here, this was the move now. The move that we're getting now, the Russell is just killing the Qs. And you can see partly because we're catching up, and we've done this before. Back here in April 21st through the 29th, we also had really strong outperformance in a short period of time on Russell. I mean, 15% gain on the Russell in a matter of a little more than a week. It's a really big move, and the Qs had their own decent sized move, 5%. But the reason why is the Russell 2000 at that point right there was languishing, not even getting into the retracement zone yet, was easily below. The bullish period right before the 21st got us up to the 38%. Well, if you look at the Nasdaq, that bullish period before the 21st, we were already through the 62% retracement level. And if you look at the S&P, we were above the 50%. Remember, this bullish period on the Russell only got us to the 38. So this period of outperformance right here basically caught us up. It caught us up on the Russell right to that point, right? That big move. All the others, the S&P was above the 50, the Nasdaq was above the 62, and so, but we were still not even in the retracement zone on the Russell. We had a big move up to catch us up, and then we languished, right? Well, now, this whole time, up until this week, we were flirting below the 38% retracement level. Well, if you look at the Nasdaq, let's look at the Nasdaq 100 here. If you look at the Nasdaq 100 during the same pullback, so here's the pullback, right? They got us actually briefly below the 38% on the Russell. That pullback didn't even get us back into the retracement zone on the Nasdaq 100. We were still flirting with a 78% retracement. And you look at the S&P, and that pullback got us to the 50%. The Russell pulled us down below the 38%. So now the Russell is right here. So this move on the Russell in this past week and a half has caught us up to the 62% retracement level on its own. So last time it had a big catch up, it fell into some weakness, because again, that's not the leadership of this market. This leadership of the market's not this like rare stay-at-home trade. The Qs have been leading this whole time. Like the Qs, if you take a look at the Qs, you can see we've been leading this entire time, really since, again, the market peaked in January of 2018 and peaked again in that August, October, September, October of 18. That is where risk appetite peaked as a whole. After that, commodities fell, yields fell, everything risk-related fell, including the Russell started to really fall compared to the Qs. So this story of the Qs leading is not new. It's been on this bullish trend this whole time, pretty much since that August high point on the Russell. Ever since then, the Qs have been leading. It just went parabolic this year, and it actually started to go parabolic even before the coronavirus meltdown. Right, the coronavirus meltdown just made it go even more parabolic up to these really extreme high levels, and now you can see a little bit of a pullback that we're getting down below the 50%. We're at a very important level, however, you notice right now, because we are sitting right here at this 1.6% level. That was the last time, again, the end of April, where we had a big catch-up. That time got us to the 50% retracement level. This time we're below it, the 50% retracement, but we are at that level again. So we've had a couple, during this pullback, we've had a couple of catch-ups in the Russell 2000. Is this the end of it, like it was before? Or, are we going to turn around? We're breaking below the 40 on the relative strength line for the Russell. We're breaking below 0 on the MACD, and you can see the PPOs coming down. So there's a good chance we might continue to go down. Now, in the past, when we've had big significant moves to the downside in this ratio, and I'm not talking about little pullbacks like this, but when we've had big moves to the upside and then coming back down, namely 98, 99, 2000, when this index corrects a parabolic move, usually both of these come down. It's not that both go up, and we've already been kind of seeing some weakness in the NASDAQ here. If you take a look here, since that gap up on Monday after options expiration, the Qs haven't gone anywhere, right? It's this NASDAQ. So our market leadership isn't leading anymore, and that's usually a sign that the move we've had going into that the move that this market leadership has led may be coming closer and closer to an end. We've seen this before. Usually at most of the ends of bullish runs, we've seen the leadership of those runs start to wane and lag, while things that have been lagging take leadership. And then we have where both start to pull back, and then you'll see that relationship part start to pull back too. So that's something to keep an eye on now that we've reached this level, now that we've had this great big catch-up here in the Russell 2000. We almost got a cluster. If you take a look at the NASDAQ 100, you can see we also got a long lower shadow. Now, that's not as bearish as the long upper shadow is, but you can see how it's kind of stalling for the last week or so in this area, with this near-term line down below 50 still, and the momentum line not getting above 80. And you can see the same thing. You look at the momentum line here, which includes, kind of where we open, where we close here. You notice as big of a range that we had today, 66.5 points. If you look between the open and the close, there's only 20 points. So again, another day where most of the gains occurred overnight and most of the selling occurred during the day. Now there was a late rally to the close, to the high close, but you had some overnight gains that started us up at these levels, and then you had some selling throughout the day. So that's why it's not nearly as bearish, because we did close with some buying, but the fact that the sellers were strong enough to come in and produce some selling makes you wonder just a little bit. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Hit that red subscribe button right here. Mouse over that red subscribe button and then hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. But more importantly, it tells us, number two, that you want us to do the video again tomorrow. It's a quick way to give us feedback. If you like our videos, let us know with one click. You can do that right now. If you don't want us to do these videos, then you don't have to click on anything. Also, while you're down there, comment. What did you get out of the videos today? What questions or comments do you have about anything I talked about, or for that matter, anything I didn't talk about that pertains to what we cover in these videos? Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter at DavidSettle42 for more content in between the videos from day to day, as I showed you earlier. And then join our Facebook, our Market Outlook Facebook group that we've created. Alright, if you're watching a video on our blog here, there's a lot of other things here on the site, including all of our classes over here on the right. You can click on this View More to see our full calendar. You've also got our Market Outlook Live. I do a trade idea in every Market Outlook video, as most of you know. At the end of the video, we will continue to review and manage those trades in this video. We do it every time I do the Market Outlook. I do a Market Outlook Live at 3:30 Eastern Time, so Monday, Wednesdays, and Fridays. So make sure you check that out there. There's a link there. If you're a monthly subscriber to our site, the Plus subscriber, you get access to all of our trading rooms, as well as our Market Outlook Live videos. Our Q&A session that you see here, Brandon's for tomorrow, that's one of our premium benefits that you have. And you can see the difference between the two if you click on pricing right here. Also, while you're here, engage with us on social media. Click this heart. That opens up a new window where you can like today's Market Outlook tweet. Also click on this thumbs up. That will this thumbs up here will take you to your Facebook page where you can like today's Market Outlook Facebook post. Again, that benefits us because the more likes and engagements these posts have, the more Facebook and Twitter will promote our content to all of our followers. It benefits you because Facebook and Twitter will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look back at the charts, and here's the big breakout this week. Big bullish breakout candle on the Heikin-Ashi to get up above the 200-day moving average, and that's not just barely getting above it. That's a good, significant breakout. We're not just flirting with it here. Here's what the regular candle looks like since we're finishing at the high of the week. That's a very good breakout. If this holds, very, very good breakout there, and you can see the PPO is already rising again from the Nasdaq 100. Remember, is already easily broken up above. So if we're going to follow the Nasdaq's lead, that's what we want. You know, the Russell 2000, you notice again playing catch up, is now sitting at the 200, not only at the 62% level, but also at the 200-day moving average. It's right there. So, you know, it's filled in the gap just like that. It's filled in the gap in 2 weeks between the 50 and the 200-day moving average, because I had a lot of underperformance to catch up. Now the question is, before we had to catch up to get to the 50-day moving average. We got through that. I had some weakness from that high down to this low. I had a couple weeks of weakness after playing catch up there to get up through the 50-day. Now we're at the 200-day. We'll see if this catch up is done, because remember again, this is our leader. This is the leader, and this is what was the leader well before this market kind of took off before and up and through these lows. Again, very similar to the 99 period where you had a big pullback in 99 where the Qs were leading the way up. You had the pullback, and then after the pullback, the Qs continued to lead the way up all the way through the rest of 98 into 99 into the early part of 2000. So very, very similar environment here. Let's take a look at the 3 green arrow chart, on the S&P 500. So again, 3 green arrows. You can see we're riding easily above and grinding above the 8-day moving average, staying above that very bullish. MACD is above its moving average. Stochastics and its moving average are back in the reversal zone. So very bullish trends, very bullish price action here. That can stay as long as we're above this 8-day. We flirted with the 17, pulled back a little bit here during that weakness coming out of that end of April, right? We had a couple weeks of weakness coming out of that catch-up period from the Russell. We'll see if that ends up being the case here coming out of this. And interestingly enough, both of those Russell catch-up periods were at the end of the month. So we'll see if that plays out, if a very similar pattern of weakness plays out after we get through the end of the month here in May. Alright, so now on the intraday pattern, you can see the gap we had early this morning that was filled in. In fact, we started to fill in yesterday's gap early this morning before the ride. Look at that rally up the rest of the day, up to the high of not only the day and the week, but also the high of the 4-week period. What's interesting here is if you look at QQQ, it is not forming a high of the 4-week period, so it's lagging. That's not the case for IWM. IWM, of course, is blowing out, and you see how it only filled in a little bit of that gap, and it's way far away from this gap. So what's interesting here, very similar to this period that we saw before. If I were to go out to the 419 period, let's just go back to the 18 just in case. So back over here in the 21st, very similar to this period where we had all these gaps, right, that we just blew up. The IWM blew up, and everything else was kind of languishing. Well, after that, during that period of weakness, we filled in all these gaps that seemingly were unfillable, right? We came in here and filled in some of these gaps, and then eventually filled in all that gap down there. So again, same thing. If you look at QQQ, QQQ had this, never did fill this gap, but some of this gaps from the 21st on. So here's the gap up, very similar to here where we gapped up here, and then we had already been filling in gaps. By the time we got to the end of the month, we had already filled in some gaps, and you can see how quickly we filled in that gap. And then the Russell, remember, came all the way down here, and the Q stayed up, so it started to outperform. But if you notice, the Qs have already started to fill in that gap, right? So that kind of shows you what we might expect to see out of everything else once this catch-up period is over. All right, so now let's take a look here at the volatility. And well, first of all, let's take a look at go back to the range for the day. As you see, today's range ended up being about average, and the volume ended up being about average, interestingly enough. So pretty, but heavier than what we've seen the last so many days, which have been well below the average. So bigger range, bigger volume. When you put those numbers in context here, 104 million down there, and almost 7-point range. So that's right there on the range. The volume is, you see how they're kind of tapering off, and they're tapering off similar to the VIX at relatively high levels. So it's not like we're continuing to drop down. The VIX is halted here right around the 27 and 27.5 area, not able to really break through this 90% mark relative to that back month volatility. So the markets have been bullish, but there's still a pretty high degree of volatility. And that volatility in multiple measures here is flattening out. Now, I did mention before, when you look at the Keltner channels and the Bollinger Bands, that the SPX kind of broke out. Was close to breaking out before when we did this video. Well, now you notice we are, like today was a breakout above that Keltner channel. Now we've had a couple breakouts. In fact, the last day of that catch-up period on the Russell. Remember when the Russell made this big move right here at the end of April? The last day of that period got up above the upper Keltner channel. And the difference there is the Keltner channels are actually inside of the Bollinger Bands at that point. This is a little different in that the Bollinger Bands the Keltner channels are outside of the Bollinger Band. So you're kind of getting a breakout of the Bollinger Band and the Keltner channel at the same time. But, again, last time we had that breakout, we went back down towards the lower Bollinger Band and made a run within this space. So keep that in mind tomorrow as we head into the last 2 days of this week. Again, a very similar catch-up period in the Russell, ending with a move up above the Keltner channel. We might be seeing something very similar here at the end of May that we saw at the end of April. Finally, I did want to bring up that volatility chart again to kind of give you an idea of what's going on in volatility. You can see, we've had such big ranges on volatility. In fact, let me take a look at this chart here and bring up the VIX. We've had such big ranges on volatility. Not surprising, right? We were really, really light down here, and when you get really small in the ranges, you tend to, at some, now you can see you can be really small for a little while, so it's not like a timely pop. But when the ranges get smaller, and you can see they've gotten smaller, and they've gotten down to this 4.5 point, and again looking like it might be, especially here on the relative, the range relative to the actual VIX level, seems to be bottoming out at a level that used to be the peak up here. So again, just something else to keep an eye on relative to pops in the volatility. You can see when it's gotten to really low levels, that tends to lead to some pops here in the volatility range. So that's something to now here with being at a low, to kind of watch, like I said, in the next few days, now that we've gotten, these really strong breakout signals. All right, so before we move on to the other segment here, just a quick review of our technical outlook. Very good breakout signals in the last few days, and it's been a positive sign for the broad market that we're kind of holding some of these breakouts. And it's been an interesting last week or so to see now finally the small cap index kind of catch up to where these other large cap indexes are. Now the question is, who will regain the leadership going forward from here? Will it be the value? Will it be the small cap, which is usually what you want us to lead on a move to the upside when you're coming up off a low point, as we said before. But that hasn't been the leadership. But before this big low point that we had, during the low point that we had, and then now after the low point, it's only been the leadership in times where it's had to play catch up before we run out of gas. So with some of these breakouts setting up some signals, some kind of pulling people into this breakout mode, that sets you up for a potential kind of fake out type move. Not a trend changing fake out type move, but one that can be painful if a lot of people are now all of a sudden getting bullish. We talked in the past about, in fact, I tweeted out earlier about, when people complain about it being bullish on the market's way up off of this bounce, a lot of times it's because we're either all bullish or all bearish. And as most market scholars know, as you've seen in our class portfolios, because of multiple time frames between long-term charts and short-term accounts, and then within our active account, which is shorter term, multiple time frames with different option strategies you can employ there, you can have bullish positions and you can have bearish hedging type positions, even while you're still wondering whether or not we're actually going to turn this into a bullish run. So that's the difference. That's the difference where if you're one-sided and you're waiting for all this confirmation that you're bullish, then you miss out. Whereas if you have some bullish positions on coming off of the low, but you're hedging it because you want to be neutral while we're trying to figure out this low point, then those longer positions that are longer term in nature to begin with, because of how significant the selling was, plays out really, really well during the bounce. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. Comment down below as to why. Let me know what you're thinking or what other comments you might have about the different charts that we've looked at today. All right, now let's take a look at what's driving a lot of this action. So let's come back to our asset class comparison and just kind of, again, take a look at that from May the 14th. Since this low point that we've had, where the Russell really started to take off, all the way up till now during this kind of catch-up period. You can see it was largely driven too by a rise in crude oil. The USO, the ETF for crude oil, up 28% off of really, really low, and it was actually lower before that May 14th period, but during this period, very strong run. And you can see it's been pulling back a little bit over the last couple of days, but those are the same couple of days that real estate and small caps have really taken off relative to the SPY. In fact, you can see IWM has been doubling SPY, and it's more than tripling, almost quadrupling what the Qs have been doing. Qs have been actually lagging SPY during this time frame. You can see also high yield bond has been doing pretty well. But what you see out here at the bottom is kind of interesting. I mean, this is pretty darn, the 7% move is good for a year in terms of an average. So to get it in a matter of a week, that's a pretty strong move. You can get 7% moves up and down, so it's not like this is a singular experience, but still, that's a pretty strong move for a short amount of time. And to get a 16% move in small caps, again, in a short amount of time. I mean, we saw from the 21st to the 29th of April, it had a 15% move, almost 16%. So, that's a strong period. Again, it's not like it's never happened. We saw it last month, but still a pretty strong run over a short period of time. But what you see here from the safe haven trades is we're not seeing the equivalent selling. They're very overbought. In fact, if you look at gold on a long-term linear regression, so like on a 10-year chart here, if you look at gold, let's pull up the gold contract. Whoops. You can see it's outside of the second standard deviation channel. It's that far up above the linear regression for the 10-year period. That's a strong parabolic move, and that was the case previously for TLT, and it's just barely starting to pull back right now below the second standard deviation channel this month. I mean, that's how strong it still is. So, big parabolic moves that were already, look at the move on TLT during 2019 going into the coronavirus issues. And there's the month, with the big range. So it kind of puts them in perspective that, we talk about, again, this move off of the August, September, October 18, where risk appetite, was started to be in the bear market. Well, you can see what gold has done since then. You can see what bonds have done since then. They have both just really taken off to extreme high levels, and neither one of them have pulled back. So if I were to go back to this asset comparison chart and again look at our other time frame of April the 21st to April the 29th, again another very strong period where the catch-up period for the Russell 2000, you can see here, is actually coming off of, it must be the 22nd on this here. There we go. Coming off of this low point here, 15% move starting on the 22nd from the open. This actually from the close of the 21st. That's why it's different on this. This chart uses the close of the prior period to start rather than the open, which is typical. So from the close of the 21st, it's up 15%. You can see doubling what the S&P was done. But again, crude oil's having its own issues during that time. But you notice we didn't see a big selling of safety trades. Like, they were down a little bit, but not down very much at all. So very, very similar pattern. The only difference is we don't see real estate making a bump up, but real estate's still doing pretty strongly there. But that's the only difference. Very, very strong pattern here for stocks, for small cap stocks relative to all these others, and not a very weak pattern in safety. So it kind of gives us an idea of what we might expect going forward, because from this day, from the 29th, pretty much to that May 14th where we bottomed out again. So here's May 14th, and let's go back to 20 minutes or so. You can see that, so during this stretch where small caps started to lag behind, you can see it over here, down 4% during that time, real estate down during that time. You can see the bounce that crude oil had, but there's gold, there's bonds, the dollar, they're all kind of holding up against these equity asset classes. So, I'm not looking for necessarily a big bearish move coming out of this today, but we've seen a pattern like this already in the past, in this past rally for that matter, this little bull market that we've been in. If you want to call the selling before a bear market, and this little bull market that we've been in, we've seen a rally like we've seen right now, and this is the aftermath. So, the aftermath that we might get might not be necessarily bearish for risk, for these risk trades as a whole, as it will be for small caps in particular, as they were the ones that pulled down the most during that time frame, down 7.5%, 8% at one point in time. All right, so if you take a look at the sector moves during that same time frame, so here's the April 21st to the 29th period, again, where small caps did really well. You notice energy did really well, materials, financials, industrials. Sounds pretty familiar, doesn't it? Technology, discretionary. Technology actually lagged a little bit here, but discretionary and communication services outpaced. And then you have your safety trades here, not surprisingly, pulling back. Well, now let's go to the 14th of May till now and see how they're performing. And look at here. It's very similar patterns. You have technology, financials, industrials leading. You have energy and materials doing well too. You have discretionary up here. Real estate's doing well this time, but discretionary communication services are doing well, and technology is up, and the safety, the safe havens gaining but lagging, lagging the market as a whole. So again, so you say, okay, well, if we're going to have a similar period to what we saw there, so let's go back to April the 22nd here through May the 14th. During the subsequent kind of sideways action where stocks pulled back from that, excuse me, actually it was from the 29th, wasn't it? So from the 29th, sorry. There we go. So after, actually it was through, the 29th was the last day, so it'd have to be the next day for the 30th. So here's the subsequent pullback during that little weakness, that weak decline. You notice that technology actually gained during that period. Communication services was up there. Discretionary, consumer discretionary. So during a pullback in risk appetite, our safety trade, utilities, real estate still lagged, but so did energy, materials, financials, industrials. So if we're going to follow a similar playbook, then look for what did really, really well during this past couple of weeks, specifically the really beaten up areas, because remember, they were beaten up the most. When you go back to the 19th of February, all the way up to that March 23rd low point, right? So, which stocks, which sectors were beaten up the most? Well, it was all those sectors: financials, industrials, materials, energy, and interestingly enough, utilities and real estate, because they had been so bullish. But they were holding up pretty well until the end. They fell down to the end, and you can see your QQQs were holding up pretty well too, and then they started to take off, and they've really done well from off of that low point. So starting with the 24th, including the gap on the 24th, all the way up till today. Energy, look at the move in energy, which has still got a lot of room to run because it was so beaten up. But you can also see materials, financials, industrials, technology, consumer discretionary, communication services kind of matching the market. The only things really lagging were real estate until the last couple of days, utilities, and staples, your safe haven trades, which is kind of what you'd expect. And you can see even all the way up to this point, financials and industrials were also lagging behind here, and your QQQ type stocks were holding up, in addition to healthcare, not surprising, and then of course energy, which had been so beaten up. All right, so for our trade today, I want to take a look at a stock that had been pretty bullish here, but has turned bearish. So you notice we got dark pink shading and a red line, similar over here, but that we didn't go very much further down. We were in a strong trend and we were holding up. And in fact, if you take a look here at that, I didn't take a look at this on the Market Outlook Live, but you notice 140, which would be an important level here, is right about the 50% retracement, and 135 is down here. So keep those two numbers in mind as we talk about the weakness that you're seeing here. From a 3 green arrow perspective on Eli Lilly, you see that you have the 8 and 17 day both coming down below the 30-day moving average. The MACD's moving average is also falling down. The stochastics is in the lower reversal zone. If you take a look at the RSI and the CCI is close to breaking down. It's already broken the negative 100 and stayed. It's close to breaking below the negative 200. See, when it breaks below 100 and stays, it's hard to be bullish. And it really is hard to get above the 100 level. And it's broken below 40 on the RSI. If you take a look at the DMI, you'll see that it has broken the 30 level on the negative directional index and below 20 on the positive directional index. Remember, this one tends to shoot up first and then slow down, right, when you're on the negative, versus the bullish, which tends to be bigger moves at the end of a bullish rally. This one actually had we were bullish for a while here, and then it broke out and then kind of slowed down with some divergences heading into that weakness. Not quite the same divergences that we had. The bullish story never really got going here because it's never really able to get up above 30 on the DMI. If you take a look at the Ichimoku cloud, you'll notice that the bottom of the cloud will be this 140 area for the next few weeks. So there's some opportunity for it to be weaker. It's got some weaker numbers here, but you can kind of get this idea that it's very strong. It's got a very strong long-term bullish trend. There's your 200-day moving average currently at the bottom of the retracement zone. Of course, by the time we get there, it'll be kind of in between, if not at the 50-day moving average. So there's this idea that we can pull. It's showing some weak signals now that could lead to more weakness heading towards this support. The last chart I wanted to show was the Bollinger Bands, and there's a significant volume node here at the 140 level. Not the point of control, that's way down here, but it's still the biggest volume node that we've got in this area here. So we can come down towards, maybe even towards this 135 level, where there's a little bit of volume at that level in the top of the value area. And in the bottom of the Fibonacci retracement zone. There's an opportunity for continued weakness before potentially bouncing off of the long-term support levels and moving back up. You can see also we're breaking below the lower Bollinger Band, as well as actually the lower Keltner channel as well. So this sets me up for, because I've got two different time frames here, 20 days out to June expiration and 50 days out to July, I can set up two different trades. So what we did was we looked at doing a short put vertical spread in July, but instead of selling the July, what I want to do is sell the June. What that ends up being is a calendar spread at the 140, that June expiration, that turns into, when I roll that calendar at June expiration, it turns into a July 140 short and long 135 a bull put spread that has a pretty decent the bull put spread itself had a pretty decent return to it. If we continue to pull back, then I get to add whatever I make. So if you notice here, like right now, if I were to throw on the bull put spread itself, you can see it's got about 100. Well, we did 3 contracts, so it's got $390 reward here, and we actually got into it a little bit with higher credit. It was a $450, close to $450 when we got into that credit, into that spread. And then if you look at the calendar spread, so we'll buy the July 140 and sell the June 140 and put that on there. So what it's saying now is if we pull back, then anything I make here, as long as we stay above 140 by July expiration, anything I make in the calendar basically gets added to that maximum gain without adding any additional risk. 1110 being the worst case scenario there to the downside. So it's a diagonal spread. It's a way to say, okay, I'm bullish in the long term, but we're in the middle of a pullback, and if it continues to pull back, I'll make some money with this calendar that I can just add to my returns on the spread to the upside. Diagonal spread and out of the money diagonal spread. Like I said, 2 trades in one. So these 2 trades here basically are the one diagonal spread that we did during our Market Outlook live session. All right, well, that does it for today. As always, you've heard from me now. Now I want to hear from you. Use that link right there to go to our Market Outlook forums on our website. You have to be a free subscriber, but I showed you earlier how to do that. And that's open up any new thread with any new comments or questions you have that you want to get. Let's keep this conversation going here in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between videos. Join our Facebook group that we've created, as well as our website at marketscholars.com, our community there. As always, thanks again. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.